Video 70, Financial Management Budgets Area 7, both sub-competencies 7.11. Review the learning objectives for this video. Financial management is tested on both the Certified Health Education Specialist and Master Certified Health Education Specialist exams, so no matter which credential you are pursuing, this material matters for you. The most common budget format in health education is the line item budget, which organizes expenses into specific categories. Let us walk through each one together. Personnel is typically the largest category, often accounting for 60 to 70% of a program budget. It covers salaries, wages, and fringe benefits such as health insurance, retirement contributions, and Social Security. The fringe rate is expressed as a percentage of salary. For example, a fringe rate of 30% on a $50,000 salary adds $15,000 in benefit costs. Supplies include consumable items like educational brochures, printing, and office materials. Travel covers mileage reimbursement, lodging, and per diem for site visits and outreach. Contractual costs are payments to external evaluators, consultants, or subcontracted partners. Equipment includes durable items above a set dollar threshold, commonly $1,000 to $5,000 depending on the funder. Items below that threshold are classified as supplies, so pay close attention to that distinction on the exam because it comes up more often than you might expect. The other category captures participant incentives, meeting space rental, and similar costs. So here is what I want you to take away from this. A line item budget is organized by expense type, and you should be comfortable identifying which category a given cost belongs in. You are doing great work learning this material. Now let us tackle a distinction that the exam loves to test, and once you understand it, you will feel much more confident. The difference between direct costs, indirect costs, and in-kind contributions shows up frequently on the certification exam. Direct costs are expenses specifically attributed to your program, such as a health educator salary, blood pressure cuffs purchased for screening events, or printed educational materials. The defining characteristic is that every dollar must be traceable to a specific program activity. Here's a helpful way to think about it. If you cannot point to the activity a cost supports, it is probably not a direct cost. Now let us look at indirect costs more closely. Indirect costs are shared organizational expenses that support multiple programs, such as building rent, utilities, and accounting services. They are calculated using a negotiated indirect cost rate expressed as a percentage of direct costs. For example, a 15% rate applied to $100,000 in direct costs adds $15,000 in indirect costs. Federal grants often cap the allowable indirect rate, so always check the funder guidelines. In-kind contributions are donated resources such as volunteer hours, meeting space, or free printing services from a community partner. Even though no cash changes hands, in-kind contributions must be documented at fair market value. This matters for accountability and for demonstrating the full scope of resources supporting a program. So let me give you the clear summary to carry with you. Direct costs are program specific, indirect costs are shared expenses calculated as a rate, and in-kind contributions are non-cash resources valued at market rates. Keep those three distinctions clear in your mind and you will be well prepared. Beyond building a budget, you also need to know how to manage one effectively, and this is where your knowledge really starts to come together. The fiscal year is the 12-month financial reporting period. The federal fiscal year runs from October 1st through September 30th, while many organizations use July through June. All expenditures must align with fiscal year dates. meaning you cannot spend year 1 funds on year 2 activities without authorization. A budget justification is a narrative explaining why each line item is necessary and how the amount was calculated. Rather than listing $10,000 for travel, you would explain the number of site visits, distances, and applicable reimbursement rates. This level of detail helps reviewers understand that your budget is realistic, and it shows that you have thought carefully about every dollar. Variance reports compare planned versus actual spending at regular intervals and flag significant differences that may require budget modifications. For example, if you have spent only 20% of your personnel budget halfway through the year due to a hiring delay, that variance must be documented and communicated to the funder. A no-cost extension provides additional time to complete activities without additional funding. Finally, every expenditure must have a complete audit trail of receipts, invoices, timesheets, and contracts. So here is your key takeaway for this section. Budget management is an ongoing responsibility requiring regular monitoring, transparent funder communication, and meticulous record keeping. I know financial management can feel a bit dry at first, but understanding these fundamentals is going to serve you so well both on the exam and in your professional life. Read the scenario stem aloud. Give students 30 seconds to consider options before advancing. The correct answer is C. The correct answer is C. Responsible financial management requires documenting variances, communicating proactively with funders, and following proper procedures for budget modifications or no-cost extensions. Option A is a misuse of federal funds and could trigger audit findings. Option B may not be required and forfeits resources that could still support the program. Option D violates most federal grant regulations, which require funder approval before transferring funds between budget categories beyond a specified threshold. Summarize the key takeaways